Do you remember when they told you silver was just another commodity? Do you remember when the talking heads on financial television dismissed precious metals as relics of a bygone era? Do you remember when your interest in physical assets was labeled paranoia? Nobody is dismissing it today. It is Monday, January 19th, 2026. And if you have been watching the retail bullion market over the last 72 hours, you have witnessed something that has never happened before in modern precious metals history. We are not talking about price volatility. We are not talking about speculative moves. We are talking about infrastructure failure. The largest retail precious metals dealer in the United States has just sent an emergency communication to its customer base. Not a promotion, not a sale, a warning. APMEX, a company that processes hundreds of millions of dollars in precious metals transactions every single month, has imposed a $500 minimum purchase requirement for all online silver orders. Let that sink in. You can no longer buy a single tube of Silver Eagles. You can no longer purchase 10 ounces of generic rounds. You cannot place an order unless you cross a threshold that would have been considered absurd just 6 months ago. And this is not where the story ends. This is where it begins. Because just 4 days earlier, the same company quietly imposed a $10,000 minimum on silver buybacks. If you want to sell your silver back to APMEX, you must send them at least $10,000 worth of metal before they will even accept the shipment. This is not a pricing issue. This is a flow problem. We are witnessing the retail distribution system cracking under pressure it was never designed to handle. The pipes are breaking. The infrastructure that connects miners to refiners, refiners to wholesalers, wholesalers to dealers, and dealers to your doorstep is failing in real time. And the most alarming part? This is happening while silver is still trading below $35 per ounce. Not $100, not $250, not $500, below $35. Silver floor pricing. Snapshot, reality checks. Let's stop for a moment and ground this in real numbers. United States, COMEX, retail floor paper spot price, $34.80, retail floor, physical delivery, $38.42 Canada, retail dealers, spot aligned with COMEX, physical floor, $44 USD equivalent, Shanghai, China, SGE, silver floor price, $46 and $49 USD equivalent. Physical settlement dominant, not optional. This is critical. China is not pricing silver based on speculation. China is pricing silver based on delivery stress. The spread between East and West is no longer theoretical. It is structural. Why minimums? Matter more than price, minimum purchase requirements are not designed to protect customers. They are designed to slow demand. When a dealer raises minimums, it means inventory is no longer flowing smoothly. It means restocking timelines are breaking. It means wholesalers are rationing supply. It means refiners are behind schedule. This is how shortages begin, quietly, administratively, without headlines. In 2020, silver shortages appeared after price spikes. In 2026, shortages are appearing before the price reacts. That is the difference. Retail demand is colliding with a system built for normal conditions. But conditions are no longer normal. Industrial demand is surging. Investment demand is accelerating. Central bank confidence in fiat systems is eroding, and retail buyers are no longer asking if silver matters. They are asking how much they can get. Global comparison. East versus West disconnect. Let's compare again, because this matters. United States. Paper contracts dominate physical premiums. Widening delivery delays, quietly extending Canada. Heavily dependent on U.S. supply chains. Premiums rising faster than spot China, Shanghai. Physical first market. Tight spreads higher floor price accepted as reality. In China, silver is not treated as a trade. It is treated as a strategic material. In the West, silver is still treated like a derivative. That mismatch cannot last. What the market is not telling you, financial media will focus on charts. They will debate resistance levels. They will argue whether silver is overbought. They will not tell you this. You cannot hedge a physical shortage with paper contracts. When dealers restrict purchases, the message is simple. We do not have enough metal for this level of demand. And when buybacks are restricted, the message is even clearer. We cannot recycle supply fast enough to meet outbound demand. This is a system problem, not a speculative one. Silver is repricing, but not where you're looking. The repricing of silver is not happening on COMEX screens. It is happening in minimum order sizes. It is happening in delivery windows. It is happening in dealer emails marked urgent. What most investors still do not understand is this. Silver does not disappear all at once. It vanishes in layers. First, retail shelves thin out. Then, minimum order sizes rise. Then, buybacks are restricted. Only after that does the price begin to move violently. We are now firmly in stage 3. The retail market is not reacting to price. It is reacting to availability, and availability is collapsing faster than anyone expected. The retail, wholesale, disconnect retail dealers do not source silver directly from mines. They rely on a chain: miners, refiners, wholesalers, authorized distributors, retail dealers. Each link in that chain assumes predictable flow, but over the last 12 months, that assumption is broken. Industrial buyers, particularly in electronics, photovoltaics, and defense, have locked in long-term supply contracts. Governments have quietly expanded strategic stockpiles. Asian markets have increased physical settlement requirements. What is left over, the free float silver, is shrinking. Retail demand is now competing with non-negotiable industrial demand. Retail always loses that fight. Floor price comparison, a warning signal. Let's look at the numbers again, because they tell a story charts cannot. United States, COMEX linked retail, spot, $34.80, real retail floor, $38.40 for Canada. Spot linked physical floor, $44 USD Shanghai, SGE. Physical settlement, floor price, $46.40 now $USD. This is not arbitrage noise. This is structural divergence. China is pricing silver based on physical stress. The West is still pricing silver based on paper abundance. Those two systems cannot coexist indefinitely. Why China sets the real price? Shanghai is not a speculative exchange. To settle a contract on the Shanghai Gold Exchange, you must deliver metal. No cash settlement loopholes, no rolling contracts, no paper substitution. This forces honest pricing. When silver tightens in China, the price rises immediately. When silver tightens in the West, the price is delayed, sometimes for months. But delay is not denial. COMEX, a market, built on confidence. COMEX functions because participants believe they will not all ask for delivery at the same time. That belief is cracking. Open interest in silver contracts represents hundreds of ounces claimed for every ounce available for delivery. As long as contracts are rolled, the system survives. But when even a small percentage demands physical delivery, stress emerges. What we are seeing in retail is downstream evidence of upstream pressure. Retail dealers feel it first, not traders. Why buyback restrictions matter more than sales restrictions? Most people focus on the $500 minimum purchase requirement. They should be focusing on the $10,000 minimum buyback requirement. This tells us something crucial. Dealers do not want small quantities of silver coming back into the system. Why? Because small quantities are expensive to process. Because refiners are backlogged. Because logistics capacity is stretched. Because the system is optimizing for large, efficient flows, not retail flexibility. This is what scarcity looks like in a modern financial system. It does not look like empty shelves at first. It looks like rules changing. Global comparison, who is prepared and who is not. United States, deep paper markets, shallow physical buffers, high dependence on imports. Canada, strong mining sector, export-oriented retail supply still tied to US wholesalers. China, aggressive stockpiling, physical first exchanges, state-aligned industrial demand. China is not guessing. China is positioning. The West is debating. Industrial demand is the silent killer. Retail investors like to think they drive silver demand. They do not. Industrial users consume over 50% of annual silver production, and that percentage is rising. Solar panels alone now consume more silver annually than the entire US retail investment market. You cannot pause solar manufacturing because silver premiums rose. Industrial demand is price insensitive. Retail demand is not. This is why retail availability disappears first. Why this time is different from 2020. In 2020, silver shortages were caused by logistics disruptions. Refineries shut down, transportation froze, demand surged suddenly. In 2026, refineries are operating, but they are fully booked. This is not a temporary disruption. This is a capacity ceiling. The system is running at maximum throughput, and it is still not enough. That is far more dangerous. Another pricing snapshot. The gap widens. Let's update the comparison. USA, retail, floor drifting upward weekly, premiums unstable, availability selective. Canada, similar trend, slightly delayed. Shanghai, floor price stable but elevated. Availability controlled, not chaotic. Stability at a higher price is healthier than instability at a lower one. Markets are telling you which model works. What happens when retail is priced out? Minimums do one thing very effectively. They exclude small buyers. This reduces transaction volume, but preserves inventory for larger clients. It also changes the psychology of the market. Silver stops feeling accessible, and when an asset feels inaccessible, demand accelerates, not declines. This is the paradox dealers fear most. The illusion of cheap silver. At $35 per ounce, silver looks cheap. But cheap relative to what? Relative to gold, relative to equities, relative to industrial necessity, or relative to a paper price that no longer reflects reality? In China, silver is already being repriced. In the West, the repricing is happening quietly, administratively, before it happens numerically. The critical question. No one is asking. The question is not, will silver go up? The question is, will you be able to buy it when it does? Availability precedes price. Access precedes opportunity. And access is narrowing. This is the phase where the system still functions, but only barely. Nothing has broken officially. No exchange has declared force majeure. No contracts have been defaulted. Yet everything beneath the surface is under strain. This is the most dangerous phase because it looks calm to the untrained eye. What physical stress actually looks like. Physical stress does not announce itself with headlines. It shows up as longer delivery timelines, selective fulfillment, higher minimums, buyback bottlenecks, widening regional price gaps. When these signals appear together, they form a pattern. The pattern is now unmistakable. The COMEX delivery illusion. COMEX was never designed to deliver metal to everyone who holds a contract. It was designed as a price discovery mechanism, not a warehouse. The system works as long as participants believe they can settle financially rather than physically. But belief is not a guarantee. When confidence weakens, delivery requests rise, even slightly. The system tightens immediately. Right now, registered silver inventories remain technically sufficient. But sufficient assumes normal behavior. Markets are no longer normal. Paper claims versus physical reality. For every ounce of silver available for immediate delivery on COMEX, there are dozens, sometimes hundreds, of paper claims. This has always been true. What is new is the growing awareness of that imbalance. Institutional players are no longer dismissing physical settlement as irrelevant. They are preparing for it. Retail stress is not the cause. It is the symptom. Shanghai versus COMEX. Two different worlds. Let's compare how stress manifests in two systems. COMEX, USA. Stress appears as administrative friction. Rules change quietly. Minimums rise. Delivery windows stretch Shanghai, China. Stress appears as immediate price adjustment. Physical premiums rise instantly. No attempt to suppress the signal. This is why Shanghai silver often trades $10, $15 per ounce higher than COMEX equivalent pricing. China absorbs stress through price. The West absorbs stress through rules. Updated global silver floor comparison. Let's anchor this again in numbers. United States, retail physical floor, $38 to $42 USD availability. Selective delivery delays growing. Canada, $40, $44 USD. Supply tied to US wholesalers, Shanghai, SGE, $47, $50 USD stable availability, mandatory physical settlement. The gap is no longer narrowing, it is structural. Why arbitrage is not fixing. This, in theory, traders should buy cheap silver in the West and sell it in China. In practice, that silver does not exist in sufficient quantities. Export restrictions, logistics costs, refining specifications, government oversight. Silver is not a frictionless commodity anymore. It is a strategic material. The silent role of governments. Governments do not announce silver accumulation. They do not publish reserve updates. They act quietly. Through procurement contracts, defense supply chains, and infrastructure programs, silver is critical for electronics, solar energy, military hardware, medical technologies. Once governments prioritize supply security, the free market portion shrinks dramatically. Retail investors never see this happening. They only see the aftermath. Why $35 silver cannot coexist with $50 Shanghai silver? This is a mathematical impossibility over time. Either Western prices rise or physical silver disappears from Western markets. There is no third option. Price is the pressure release valve. When price is suppressed, pressure moves elsewhere, into availability. That is exactly what we are seeing now. The moment before, repricing. Historically, sharp silver repricing events share common precursors. Regional price divergence, delivery restrictions, rising industrial demand, administrative rationing, media silence. We now have all five. What happens next is not gradual, it is sudden. Why? Media will be late again. Financial media reacts to price, not structure. They will not report on minimum order changes, buyback thresholds, refinery backlogs, dealer communications. Because these are not market data, they are operational data. By the time price reflects reality, the opportunity window has already closed. Retail investors are always the last signal. Retail demand is often mocked, but retail behavior is the canary in the coal mine. Retail buyers do not act on charts. They act on instinct, fear, and availability. When retail starts hoarding physical metal at scale, it means trust is breaking. That trust is breaking now. Another global snapshot: pressure is rising. USA paper calm. Physical tension. Canada echoing US stress. Smaller buffers. China controlled supply. Higher pricing. No panic. Which system do you think survives longer? The question. Institutions are asking. Quietly, institutions are not asking, will silver go up? They're asking, will we be able to source it reliably? Once that question dominates, price becomes secondary. Access becomes primary. Why repricing will be violent, not gradual? Because suppression creates stored energy. The longer price is held below equilibrium, the sharper the release. Silver does not move often, but when it moves fast. What comes after? Physical stress. After physical stress comes repricing. After repricing comes regret. Not regret for buying too early, regret for assuming access would always exist. Every market that experiences a true repricing event follows the same pattern. First comes denial, then distortion, then restriction, and finally, release. Silver is now standing at the edge of the final phase, not because of hype, not because of speculation, but because the system that supports its pricing can no longer carry the weight placed upon it. This is not a theory, it is mechanics. What a repricing event actually is, and what it is not. A repricing event is not a rally. It is not a bull market. It is not momentum driven. A repricing event is the moment when price realigns with reality after being artificially restrained for too long. In silver's case, reality includes finite annual production, rising industrial dependency, strategic accumulation, a shrinking free float, a paper market many multiples larger than physical supply. When those forces collide, repricing is not optional. It is mandatory. The final illusion: there will be time. Every suppressed market shares one fatal assumption among participants: there will be time to react. There won't be. Repricing does not occur gradually because gradual change allows the system to adapt. Silver repricing happens in jumps, not steps, gaps, not trends. By the time price becomes the headline, access has already vanished. Step 1. The paper market holds. Briefly, in the early phase of repricing, paper markets attempt to maintain control. Futures remain open. Trading continues. Volatility spikes, but stays contained. Commentators declare it a speculative surge. But beneath that surface, something critical happens. Physical spreads blow out. Comic spot might move from $35 to $42. Retail physical moves from $42 to $58. Shanghai quietly holds above $60. The price you see is no longer the price you can pay. Updated global comparison right before the break. Let's project the stress scenario based on historical behavior. United States, paper comics, $40, $45. Liquidity intact, confidence fragile. United States, retail physical, $55, $65. Severe availability constraints. Canada, 58 tourist, 68 USD equivalent delayed fulfillment, allocation only sales. Shanghai, China, $62, $70 USD equivalent, stable settlement, controlled access. Notice something important. China does not spike. China leads. The West reacts. Step 2. Administrative controls expand. Once physical pressure intensifies, rules multiply. Not because of conspiracy, but necessity. Dealers introduce allocation only, sales customer priority tiers, institutional preference, further minimum increases. This is not panic. This is rationing. Rationing is the market's way of admitting scarcity without using the word. Why rationing is the point of no return. Once rationing begins, the market cannot return to normal. Trust is broken. Buyers stop asking when prices will drop. They start asking if supply will exist. This flips behavior permanently. Silver stops being an investment. It becomes an insurance asset. Insurance is not price sensitive. Step 3. The media discovers silver. Too late. Financial media always arrives late. When silver finally moves violently, coverage explodes. Silver shocks markets. Unprecedented surge. Retail frenzy. They will blame social media speculators, retail traders. They will not mention years of suppressed pricing, structural supply erosion, physical settlement stress, because those stories cannot be told in sound bites. What happens to retail access after repricing? This is the part almost no one talks about. After repricing, retail access does not normalize. It contracts further. Why? Because higher prices do not create silver. They merely reveal who controls it. At elevated price levels, governments secure supply, industrial buyers lock contracts, institutions hoard inventory, retail becomes last in line. Not because retail doesn't matter, but because retail is unpredictable. Historical parallels, without hype. Every major repricing event in commodities followed the same sequence. Uranium, 2005, 2007. Nickel, 2022. Natural gas, multiple cycles. In each case, paper pricing lagged, physical access disappeared, price moved vertically, then stabilized at a higher plateau. Silver has simply taken longer. Because its suppression was deeper, why silver's plateau will be higher than expected. When repricing completes, markets do not return to old levels, they reset. A suppressed asset does not return to its prior fair value. It overshoots, then settles. Silver's new plateau will reflect industrial necessity, strategic irrelevance, monetary hedging demand, not speculative enthusiasm. China's role in the new silver order. China will not chase Western price spikes. It will anchor stability. Once silver reprices globally, Shanghai becomes the reference, not COMEX. Because settlement matters, and the world is rediscovering the difference between price discovery and price illusion. The Western market's choice. The West faces a choice. Allow price to rise or accept permanent shortages. There is no third option. Markets always choose price eventually, because shortages destabilize systems faster than inflation. Why this is not the end, but the reset. Silver's story does not end with repricing. It begins again, honestly. A repriced silver market is smaller, tighter, more transparent, less liquid, more respected. It will not be cheap, but it will be real. The final question. Investors must answer. Not, how high will silver go? But, do I want exposure before or after access disappears? Price can be paid, absence cannot. Final global snapshot. The new reality. USA, paper market diminished. Physical market prioritized Canada. Export pressure, domestic constraints. China, stable pricing, strategic control. The center of gravity shifts, quietly, permanently. Closing, the part no one wants to hear. When this repricing is complete, many will say, I knew something was wrong. Very few will say, but I acted before it became obvious. Markets reward foresight, not confirmation. Silver is not warning anymore. It is signaling, and signals do not repeat forever.